Good afternoon, everyone, and welcome to this month's webinar, Insurance Planning for Clients in Their 30s. Today's presentation will last about 50 minutes, and as you know, we love questions, so feel free to ask them on screen throughout the presentation. And then at the end of the presentation, we'll do our best to leave some time to allow for verbal questions as you raise your hands on screen. Regarding CFP-CEs, if you're logged into the webinar today for more than 50 minutes, we'll report your attendance to the CFP board, and that process can take up to about a month. If you've been with us on any of our other webinars from February through April, you've walked with us through the lives of one couple, Sam and Sally, through the ages. This month, they're in their 30s, and we'll follow them through to the end of their policies, to the end of their lives, and the end of the year, December. Each month, we'll focus on an age range and the types of insurance appropriate for your clients in that stage of their lives. Today's presenter will walk you through why disability insurance should be on your clients' minds beginning about in their 30s. And now about your presenter. She's been in the insurance industry since 1982. She spent 10 years with Celtic Life, managing the company's operations and corporate regulatory compliance. She came to Low Load in May of 2005 with experience in practice management, marketing, new business development, and agent training. Since joining LLIS, Kathy has handled life, disability, long-term care, and combination cases involving those products. She was promoted in 2010 to Vice President of Advisor Services, where she works with advisors and their clients to tailor disability solutions that fit their individual needs. She's got a medical background, which provides Low Load's clients and advisors with knowledge and expertise that's helpful when navigating the underwriting experience. Please welcome Kathy Copack.
Thank you, Dina. Well, this is quite a timely presentation since this month is Disability Insurance Awareness Month. As Dina said, we've followed our couple, Sam and Sally, since March, and now they're in their 30s. They've started the foundation of their financial future and are now focused on protecting their earning potential. How can disability insurance provide protection during these important earning years? All right, what are we going to cover today? We're going to go over some scenarios where your clients don't have any existing disability insurance and scenarios where your client may come to you with existing disability, such as individual coverage, group, or association coverage. We're going to talk about retirement protection and also the new professionals program, which is specifically designed for your clients in their 30s, and it also offers a graded premium. And lastly, we're going to talk about specialty lines, which is designed for your clients that might be professional athletes or have any other type of unusual occupation or income. What is your client's most valuable asset? The foundation of your planning is based upon your client's ability to earn an income. We help you protect your client's income in the event of a disability. If your client had to stop working today due to a disability or their lifestyle and financial situation changed dramatically, well, they have to consider filing for bankruptcy. Most of your clients probably know the importance of having homeowners insurance for their home, car insurance to protect their car, and health insurance to stay healthy, but they may not realize there's a disability insurance to protect their income. Perhaps some of your clients will tell you that they have group insurance at work, so I don't need to worry about that. Well, we will look at various situations where, during our presentation, where they really should not be worry-free. But first, let's look at some statistics to help illustrate the need for protection in the event of a disability. Did you know that 30-year-old clients are 4 times more likely to become disabled than die prior to age 65? And did you know that 3,000 Americans became disabled in the last hour, which equates to 49 disabilities every minute? In addition, a 30-year-old earning $50,000 a year could earn more than $4.5 million by age 65. So this is the earning potential that we're trying to protect with disability insurance. Now let's get started on reviewing the information necessary to evaluate the need for disability insurance. What determines eligibility amounts? First of all, your client's income. This is income such as W-2 income, plus any type of bonus or commissions that might be 1099, such as a real estate agent. We're going to take a look at all of those. What their occupation is. Let's say Let's say you tell me your client's a salesperson. That really doesn't give us the full picture. Perhaps your client is a salesperson for bulletproof vests, and they test them. That really isn't telling us the true picture. Or perhaps your client's a radiologist. Is the radiologist performing any type of invasive procedures, or is he just reviewing CAT scans, X-rays, or MRIs? In health. Health is important because for life insurance, it may not be important if your client is seeing a chiropractor, but in disability, it can be a completely different situation. Our first scenario is going to be a client with no existing disability insurance. So how do you go about getting coverage for your client with no disability? In this section, we will go over the steps necessary to procure a disability quote from Low Load. The first thing that I'm going to need is your client's base salary and whether they're generating any type of bonus or commission, and if they're generating any type of unearned income. The three most common types of unearned income that I see are trust, net rental property income, and investment income. The reason this is important is simply because this type of income will continue to flow to your client in the event of a disability, and insurance companies will limit the benefits that they're available for. Now, here are the basic components that make up a disability plan. First of all, we have the base monthly benefit, which is the amount that your client will receive at the time of disability. The elimination period that I usually use is 90 days. The reason for this is simply because most financial planners instruct their clients to have at least 90 days of emergency cash available to them. And during the 90 days, your client would be self-insuring while they're disabled. The benefit period is the time frame for which your client will be eligible to collect benefits. And unless you tell me otherwise, I almost always will run a age 65 benefit period unless your client isn't eligible for it. And then lastly, the riders that LLIS believes should be on every single plan are the future insurability option rider, the residual rider, the cost of living adjustment rider, the catastrophic rider, and the retirement protection rider. We will go into greater detail on the retirement protection rider later on in the presentation. But for now, let's go into greater detail on these individual riders. The first one, the future increase option rider, is the rider that allows your client to increase their monthly benefits as their income goes up. The reason this one is important is because there's no medical underwriting, it's simply financial underwriting. The residual rider, which is the most important rider that we believe you can have on a plan, it allows your client to collect benefits if they're working part-time. In other words, if your client's doctor deems your client totally disabled, that would be the only way they could collect on their plan. But with the residual rider, it allows them to collect benefits if they're working on a part-time basis and they're losing 15 to 20% of their prior year earnings before they went out on claim. A good example of the residual rider is, let's say your client was diagnosed with cancer and they're going to be undergoing perhaps chemo or radiation, and they're not able to work full-time. This would allow them to ease back into the workforce little by little on a part-time basis and still be able to collect not only their paycheck, but a portion of their monthly benefit from the disability plan. The next one, the cost of living adjustment rider, is the rider that kicks in once your client has been out on claim. It's usually increased on an annual basis. It's about 3%, and it is compounding. The catastrophic rider, if this one is added to your client's plan, it will almost get them to 100% of their earnings. And there's 2 to 3 triggers that are associated with the catastrophic. Examples would be if your client has lost the use of both arms and both legs, or one arm and one leg, the ability to speak, vision in both eyes or hearing in both ears. If they suffer a cognitive brain impairment, such as a brain injury or dementia or Alzheimer's. And lastly, for those of you who are familiar with the activities of daily living associated with a long-term care plan, if they lose 2 or more of their activities of daily living, bathing, dressing, toileting, eating, transferring from bed to chair, they would be eligible for the catastrophic rider. And the retirement protection rider, like I said before, we're going to be going into greater detail with that one in the presentation, so we're going to kind of go over that one later on. Individual plan. Why is it important for me to know the details of your client's occupation? Well, it can affect the classification that the carrier assigns to your client, and that can affect the premium associated with the plan. It's important for me to know what your client's duties are. I need to know if they work in an office environment or if they're working on a construction job site. Their managerial duties, are they supervising white collar or blue collar? Manual duties, are they sitting in an office at a desk or are they more of a physical nature? Travel, if they're traveling 25% or more of the time, that can affect their class simply because if they were to become disabled, they would probably not have the ability to get on and off a plane or perhaps a train. And then lastly, home-based occupations. Insurance companies have a problem with people who work at home if there isn't any eyes and ears on them. So they have some limitations, but they don't restrict those limitations if your client is self-employed and is out and about seeing their clients 40 to 50% of the time. A good example of this are perhaps a consultant or IT people. If your client is self-employed and in business for 2 or more years, such as a financial advisor. We have a lot of financial advisors who work from their home office, and as long as their tax returns can show that they're generating an income for the last 2 years, it wouldn't be a problem. Another example would be a bookkeeper. And then lastly, if your client is not self-employed, such as a Microsoft sales rep or a software engineer, and they're out and about but they work from home, that's considered their home office, there would be no restrictions on that plan either. Occupation definitions. Your client's occupation definition determines the benefits he or she is going to be eligible for and what they also qualify for. It also determines how disabled they are and what they can get once they are disabled. It is an important element of a disability plan because you want to make sure your clients don't go from being a surgeon to slinging burgers at McDonald's or being a greeter at Walmart. Their occupation definition isn't something that you determine, but rather I will work with the insurance company to determine which occupation definition fits them. This chart shows the different occupation classes ranging from what comes with most group policies, which is the any occupation definition. And this one basically says that if your client can't do their job, they can be asked to do something else, such as the greeter at Walmart. The next one, your occupation, which is the definition that's most associated with an individual disability plan that does not have a rider for the transitional or own OC. And the transitional occupation rider is the one that will allow your client to work in another occupation, but if they're losing a portion of their income, they're going to pay the difference. And then the last one, the own occupation definition, this is the one that is most sought after. It's the most expensive, but it's the most comprehensive because it says if your client can't do the substantial material duties of their occupation and they choose to work in another occupation, not only will they generate an income from their new occupation, but they will be collecting 100% of their disability benefits also. Examples for the different occupations would be in any occupation, probably plumbers or mechanics, their disability plan. Your occupation would be people such as school teachers, office workers, management like myself. Transitional would be people such as IT consultants or any type of service personnel. And ONOC would be your physicians, your dentists, your scientists, your lawyers, your CPAs. Just keep in mind that that is something that I will work on with the insurance company unless you ask me specifically to make sure it has one of those riders on there. Now, in order to help illustrate the various definitions, because I know they can be really confusing, we've created 4 different scenarios. And these scenarios are based upon Sam, who's now 40 years old, and he's a CPA, and he's making $225,000. And even though he's eligible for more than a $10,000 monthly disability benefit, for the sake of illustration, we've used the $10,000. So here's the 3 different definitions that we talked about. In all 3 of these, because he's not working, he's disabled, he's going to collect the $10,000 benefit from all 3. And keep in mind that this particular scenario on all of these has the residual rider built into it. And Sam purchased this policy, thank goodness, when he was 32, so that when he does obviously turn 40, he has some coverage available to him. In the second scenario, obviously he was still making his $225,000, but he got a job as a teacher and he's generating $47,000 from his new occupation, but he's still losing almost 80% of his pre-disability earnings. And here we have the three definitions. Basically what this is saying is because in all three scenarios he's losing, in the last one, your occupation, he's losing more than 75% of his income, he's still going to be eligible for the $10,000. The transitional, again, he's not making enough in order to generate any type of income from his new job that would surpass what he would get on his disability. So he's going to be eligible for the full $10,000 on the transitional. And the ONOC, because that's the strongest definition, which says you can't do the substantial material duties of your occupation, which he's not performing as a CPA, but rather as a teacher, he's eligible for 100% of his benefit. In our third scenario, he's doing much better. Sam has gotten a job as a state auditor, and it's paying $112,500, which is approximately 50% of his pre-disability earnings. So let's look at the difference here. The ONOC is going to be the same because he's not a CPA, he's a state auditor. The transitional takes into consideration that he's now making half of his income. So his monthly disability benefit is approximately $93.75. And that amount is based upon the fact that the $112,500 he's now getting from his new income reduces that by about $625. And the last scenario, your occupation, takes into consideration that he's now generating 50% of his pre-disability earnings. So 50% of $5,000 a month is $5,000. And then our last scenario is Sam being promoted to the state auditor supervisor position, where he's making approximately $206,250. So he's doing pretty well. He's almost at his pre-disability earnings income. So he's only showing an 8% loss of earnings. Again, with the ONOC, he's not a CPA, so he's going to get his full $10,000 a month. In the transitional, he's short $18,750 a year, which would get him to the $225,000. So the disability benefit is still going to make up that shortfall, and $18,750 divided by 12 is $1,563 a month. And then the last, your occupation, because he's only losing 8% of his pre-disability earnings, he's no longer eligible to collect any type of benefit off of that plan. And you might be wondering, well, what is the difference in the cost for each of these riders? Well, the own occupation rider, which is the most expensive, is only $4,200 versus the transitional, which is $4,000. And then the your occupation is going to give a cost of $3,810. But remember, the CPA would have qualified for more than the $10,000, but again, we used this amount because it was easy to understand. Occupation classes. Why are these important? Well, first of all, they're important because they can affect the premium, the benefit amount, and the riders on the plan. And occupation classes range from B to 6, with B being your more manual jobs, while the 6 being occupations such as a lawyer, CPA, and actuary. And the lower the OCC class, the higher the premiums. And the reason for that is if you have someone that's working in a B classification, such as a plumber or mechanic, and they injure their hand, there's a greater likelihood that they're going to go out on claim because they can't perform their job, whereas an attorney who might injure his hand could probably still go to trial, could probably still prepare reports. And that's the reason for the differences in the OCC class. And here's an example of some occupation classes. This is a chart that illustrates from the highest cost per thousand to the lowest cost per thousand. That's not to be confused with the most expensive to the least expensive, because it all boils down to the benefits available in these different classes. For example, the A's and the B's, which is the lower end of the occupation class, they're not going to be eligible for a 5-year benefit period. So that's going to lower their premium. They're also not going to be eligible for the own occupation or the transitional rider, so that's going to lower their premium. These classes have to do with the likelihood that your client will lose their income due to their occupation. So people such as baggage handlers and mechanics have a greater chance of being injured than a CPA like our Sam. So underwriters do look at occupation classes because it's based upon claims experience. So for instance, if you look at 4, we have a financial advisor in 4 and we have a financial advisor in 5. Well, the difference between the two is simply they both have to have been in business for 5 years, but the one in the 4, their income has to be $75,000 or more, and the one in the 5, the financial advisor has to have been making $100,000 or more. Okay? With disability coverage, we have medical underwriting, but we also have another component, which is financial underwriting. And you might be wondering what would be reviewed for the financial side. Well, here's an example of the types of documents that would be required. And I'm going to tell you, on most of the plans that we're looking at, we're going to see tax returns, W-2s, and year-to-date pay stubs for your typical W-2 employee. If you have a client that's self-employed, we're probably going to need their 1099s or their K-1s if they're an S Corp. The P&L is for your clients who are interested in business overhead insurance. And again, like I mentioned, for everybody, if they're generating any type of unearned income, that would be relevant for all your clients. The reason, again, that this is important is it helps determine the monthly benefit that your client is going to be eligible for. We need to show proof of what their income is. Underwriters are concerned about mortality with life insurance, but with disability insurance, they're concerned about morbidity issues. In certain situations, we had a client who was approved super preferred for their life insurance and outright declined for their disability. And the reason for this was simply because the client did not indicate to us that they were suffering from macular degeneration, which would not affect life insurance because it's not a life-threatening condition. But the fact that they could become blind was an outright decline for disability insurance. So the underwriting for disability is going to be a little different in that with life insurance, you can increase the premiums, usually called table ratings. But with disability, not only do you have ratings, but they have the ability to put an exclusion on a particular body part and or a particular condition. Now, I chose to put this one on simply because this is probably the most common exclusion that Jenny and I deal with on a monthly basis. It's the mental nervous exclusion, and some people will always ask me, I don't understand, I'm getting a mental nervous exclusion put on my plan, but they're limiting the benefit period to 5 years. And the reason for that is claims experience has proven that people who have an emotional disorder or a psychological disorder and are taking any type of antidepressants and or are going through any type of counseling or therapy have a tendency to go out on claim for something that would not come under the mental nervous heading. Examples of those are GERD or acid reflux, headaches such as migraines, rapid heart rate, and insomnia. So when you see a benefit period that's reduced to 5 years and you see a plan that only has one rider on there, which is residual, chances are it's because your client is taking some sort of antidepressant. Now, keep in mind that 10 or 15 years ago, that same client that's getting the mental nervous exclusion probably would have been declined. No coverage would have been offered at all. But because of the new underwriting guidelines, they are now allowing these people to get coverage for all the other thousands of things that could go wrong with them. And basically what they're doing is they're putting an exclusion on that plan. And it does help in that it lowers the premium since the benefit period is only going to go for 5 years and they're only paying for the residual rider. And keep in mind the average claim is a little less than 3 years. And with low load, what we do is we pay close attention to the underwriting decision. In other words, if there is a situation where an underwriter will reconsider that client if they go off medication or if they go treatment-free, low load prides themselves on the fact that we circle back to that client during that expected time frame and we make an attempt to get those exclusions or those ratings removed. And I gathered some information just to give you an idea of how successful we are in that. And in the first quarter of 2013, we had a client who had a back and a neck exclusion removed. We had another client with a knee exclusion removed, and we had a third client with a shoulder exclusion removed. And during the fourth quarter of 2012, we had a 25% rating removed from a disability plan. We had a mental nervous exclusion removed. And I think this one is probably one that really shows how hard we work. We got a client who was declined, approved for a full insurance plan. Somewhere in her medical records it indicated that she was suffering from, or that a doctor suspected she had rheumatoid arthritis. Well, that is not something any insurance company is going to cover. And through her own expense, she went back and had a complete workup done and proved that she did not have any type of rheumatoid arthritis, and the insurance company gave her a complete disability plan. So like I said, we are successful at that. And lots of times, I'll tell you this, there are times where people are not real happy with the offer, but by virtue of the fact that Jenny and I keep our promise that we are going to circle back to them and we'll do our best to get the exclusion and the rating removed, that promise alone sometimes is what will tell them, okay, I'm going to go ahead with this. So keep that in mind. These are removable exclusions. Some of them I just gave you an example of. These are exclusions that we can get removed within the time frame that the doctor has, or excuse me, that the underwriter has indicated. Headaches such as migraines, back adjustments. By adjustments we mean people who see a chiropractor periodically for an adjustment. This is not people who have a bulging disc or some sort of serious back issue. Mental nervous, keep in mind this one, like I said, you have to be off medications for 2 years and you have to be treatment-free, meaning no therapy, no counseling. And then female gynecological issues. If you have a female client who had an abnormal pap smear or an abnormal mammogram, and they go back to their doctor a year or two later and they're able to get a normal result, we can get that removed. The important thing here is to keep in mind that positive change has to be documented. People who are on medication for mental nervous can't just decide to go off themselves. It has to be documented that it was a decision and that someone is tracking this. If someone has a rating on their plan because of their build and they decide to lose weight, they have to go to a doctor and have it documented what their weight is. Okay? Now, these are some permanent exclusions that will not be removed from the plan. Arthritis, like I said before, our client was completely declined because of the possibility of her having rheumatoid arthritis. Another one that we see a lot that's questioned, matter of fact, I have a dermatologist who I was talking to the other day, and she was like, you're kidding me, this is primarily what I do in my practice is I remove these. And I had to explain to her that, you know, in the eyes of the insurance company, these are a precursor to melanoma, which obviously is the most serious of the skin cancers. So they're not going to take this on. They're just going to put a permanent exclusion on. Hardware in a joint. Funny story here, I'm actually dealing with a client who has a workers' comp issue because in 2006 she's an exhibitor for a museum and she broke her ankle. They put 2 screws in it, and during the time that she was in the boot recovering, her gait was adjusted, you know, so her hip and her back were bothering her, and she got to the point where she was pretty much okay, and then 2 years later her ankle was bothering her and she decided to have the 2 screws removed. So again, she had to go back into the boot and threw her gait off again, and she's suffering from permanent hip and back issues, and the workers' comp company finally paid her settlement earlier this year. So that's another reason why insurance companies won't touch people that have hardware in a joint. Bipolar disorder, chances are this is a permanent. You're not going to overcome a bipolar disorder. Infertility and C-section. During the childbearing years, this could be an ongoing claim for insurance companies for females. So they are not going to cover this. Okay, so now let's look at an example of a client that doesn't have any disability coverage at all. This is Sally, who is our spouse of Sam. She's 32 years old. She's a teacher. She's considered a 3A, and her her salary is $45,000 a year, or $37.50 a month. We were able to secure her $2,675 of monthly disability at a cost of $2,084. So if she was to go out on claim right now, she'd be able to collect $26.75. Keep in mind that the 2084 premium includes 3% COLA, the residual rider, and $1,075 of monthly catastrophic, which is paid on top of the $2,675 benefit. All right, now we're going to talk about existing group disability coverage. And this is where we talked about where your clients come to you and you're reviewing their financials, and when the topic of disability comes up, they say, oh, no, we don't need to talk about that. I have group disability. Well, that's where you need to dig a little deeper, because they may not know what they really would get on a monthly basis from an employer's plan in the event of a disability. And they may not realize that if their employer is paying for it, it's going to be a taxable benefit. So I'm going to help you help them. Let's talk a little bit about group disability and things that you need to be aware of when you're reviewing their disability plan. First of all, group disability has a cap. Very unusual to not have one. So most disability plans have a cap of 60% to perhaps $5,000, $3,000, $10,000. In addition, if their employer is paying for it, it's a taxable benefit. So your client's going to get a 1099 at the end of the year. In addition, if your client is generating any type of bonus or commission, there is no coverage for that. It's also offset by Social Security. Keep in mind, Social Security is very difficult to get, but if by chance they're able to get it, that would be subtracted from their group plan. And I'll just tell you real quick, with Social Security disability, you have to be totally disabled for 5 months to be eligible. The average claim takes 3 years to get through, and that's with the help of an attorney. And the average monthly disability benefit is just over $1,000. So if your client is going to say, you know what, I'm not going to rely on anything other than disability through the government, you need to tell them that's not a good plan. And then lastly, like we talked about, most disability plans have the NEOC definition, which means if your client can't do the substantial material duties of their job, but they have a skill set to do another, they will be asked to do that. Okay, individual. What differentiates individual? Well, we go beyond the cap. We don't have a cap. We can go to what the issue and participation limits allow with each carrier. In addition, because your client is paying for it, it's non-taxable. We also can cover bonuses and commissions. It's portable. So if your client decides to leave their employer, they get to keep their plan. It'll go with them from one end of the country to the other. It's also non-cancelable and guaranteed renewable. These two things basically mean that as long as your client continues to pay the premium and doesn't allow the policy to lapse, it cannot be canceled. And as long as they don't do anything to affect a change in the plan, the premium cannot be increased. And lastly, like we talked about, we can add that ONOC or that transitional occupation rider to the plan. So why do we need this information? Like we talked about before, we're going to need to know their income, base, bonus and commissions, their occupation, their health, and then, like what we just talked about, we're going to need to know what their group insurance is. It's important for me to know this because if I don't have an idea what their current group coverage is, I won't be able to run an accurate quote that will help supplement their current coverage. So if they're unable to tell you that, our recommendation is for them to go to their Human Resources Department and ask them if they can get the document pages or if they can supply them with the information that I would need regarding their group coverage. So what can existing group coverage do? Here's an example. Sam is our CPA, and he works for a firm that does supply group disability, and it's based upon his income of $75,000 base, and he is generating a bonus of $5,000. His benefit is taxable because his employer is paying for it, but it has a maximum, like I talked about. His is 60% to a cap of $3,000, and it's only on his base salary of $75,000. This does not include his bonus. So what are you going to focus in on? We're going to focus in on the fact that he has a cap of $3,000. And let's look at what that does. What happens is if you have Sam who's making $75,000 and $5,000 bonus, we break that down into a monthly. So $5,000 is $417 a month, and $75,000 is $62.50 a month. Well, if you look at his group coverage, he's going to get $37.50 is what his monthly pay is if you take 60% of it. But is he realizing that he's already over? The cap is $3,000 and 60% of $6,250 is $3,750, so he's already in the hole. Plus, the group plan doesn't cover bonus, so we're only talking about his base salary here, and he's already over the maximum amount. So we've identified what we consider to be a gap, and the gap is basically the amount that your client is eligible for and what he's getting if he was to become disabled today. So we were able to layer $2,250 a month of supplemental coverage at a cost of $841 a year, which is dirt cheap because he's so incredibly young. So in this instance, if he was to become disabled, he'd be collecting $5,250 a month versus $3,000, which is taxable. So this is a situation where it's really important that you sit down with your client and you dig a little deeper and you explain to them, you know, what the real situation is. And if you're not comfortable doing that, just contact me. I'd be more than happy to take a look at the spec pages of the group disability plan. Okay, so let's review. What does group provide? Well, group provides 60% of the pre-disability earnings. With supplemental, it's not going to get to 100%. We're only going to get to about 78.5%. And the reason for that is if your client gets 100% of their income, there's really no incentive for them to return to work. Retirement protection. This is the one I said that we'd be talking about later on in the presentation. And the reason we've waited to the end to give this is simply because we wanted to illustrate Sam, where Sam thinks he has all the disability coverage he needs, and we were able to find out that he does, in fact, need more individual coverage. So he came to you thinking he didn't need anything, that he had everything he needed with the group. We identified the gap, and we're able to fill that with an individual plan. So now he has a plan that's going to cover his mortgage, his utilities, and any of the other household expenses. But Sam's been contributing to a 401k plan, and we're now concerned about what happens if he should become disabled and those contributions into his 401k stop. So let's take a look at what we can do. Since you're the advisor, and I'm sure one of the things that you're looking at long range is your client's retirement plans. And this is a plan that I think can help them protect your plan for them. Every year, the federal government determines what the limits are. And for 2013, the defined contribution limit is $51,000, and for a 401k and a 403b, the contribution limit is $17,500. The purpose of the retirement protection plan is to not replace, but basically to emulate what those contributions are. These plans are not qualified. They are not qualified because they're put into a trust, and that trust puts them into a fund that you and your client would choose. And it kicks in about 180 days after your client's been disabled. And basically what's going to happen is behind the scenes, that money is going to be funneled into the various funds that you've chosen, and it's going to generate interest and capital gains. And it's going to simulate a non-qualified plan. So let's review what we've done. We talked about the fact that Sam had some gap, and we covered the gap, the $5,250, which is providing him with 78.5% of his income. But we have a gaping hole here in case something happens to him. He's not able to contribute to his 401k. So what we did is we ran a quote, and we were able to cover him for $1,050 a month into a trust that would help replace those retirement contributions. So between his monthly disability benefit and his retirement protection plan, we're covering about 94.5% of his income. And if you can recall, the $5,250 monthly benefits annual premium was $841. The retirement protection plan is an annual cost of $239 for a grand total of $1,080, which is about 2% of Sam's annual income, a small price to pay for the protection. And you might be asking yourself, well, what if Sam waits? What if he doesn't do what he's supposed to do now? Well, this illustrates today's cost if Sam was 42 and waited 10 years. And what this does is it simply says that that same $5,250 is obviously going to be there, and the $1,050 that he would put in is going to cost $354, and the $841 for the disability benefit is going to cost $1,275. So the difference is about $600, and you might be asking yourself, well, you know, that doesn't seem to be that big of an amount for 10 years. But what you have to remind yourself is for 10 years, he's not doing anything. He's losing out on the money that would have been put into his retirement, not to mention the disability benefit. And that's retirement earnings that is not going to grow. So let's review again. We filled the gap, and now we fill the retirement protection. But again, we're not at 100%, and that's because there's no incentive for your client to return to work if they're getting 100%. But we're getting pretty close. We're at 94.5%. So let's just recap. Again, Sam came to you thinking he didn't need to discuss disability coverage because he was fully covered through his employer's plan. But we determined that he had a gap. We were able to fill in with an individual plan. And then we talked about the fact that he's contributing $15,000 a year into his 401k. What happens if he becomes disabled? We talked to him about possibly a retirement disability plan that would replace that. And he decided to go ahead and purchase that. So now he has protection for both his earned income and his retirement contributions. The new professionals program, I think, is highly appropriate for this month's webinar because it's designed for your clients who are young, usually in their 30s, and they might be students, or they might be young professionals, or they might even be children of your clients. The new professionals program is designed to offer protection now for people who will be high wage earners in the future, such as dentists, physicians, scientists, CPAs, lawyers. Their earning potential is much higher in the future than their current earnings. So let me explain this in greater detail because this next slide will help illustrate it. These are some examples of the different occupations that are eligible for this particular program. And again, a lot of these particular occupations are people who are going to be in their 30s, going to medical school, going to dental school, and the beauty of this plan is they don't have to have any type of documented income, and they might already be enrolled in a group coverage, perhaps through their hospital that they're doing their residency in. That isn't taken into consideration. This is an automatic amount that they're eligible for. And the beauty of it is that it comes with all the typical riders that we talked about earlier that Lolo thinks is important to have on a plan. The FIO, the catastrophic, the COLA, the residual. Those are all going to be eligible for these particular plans. And then lastly, a nice feature about it is it has a graded premium. The graded premium allows them to purchase a full-blown plan, but at a reduced cost. And by reduced, I mean about 56% compared to a level premium. And what we usually do, because we like to circle back to our clients, again, we circle back on the FIO, we circle back on the ratings and the exclusions. We also make it a point to circle back to the clients who've purchased the graded premium. And generally speaking, when I do this, I don't do it the first year, and sometimes I don't do it the second year, because we're conscious of the fact that these particular individuals are probably paying back student loans, and they're not ready to convert that graded premium to a level premium. But probably by the third year, I'm going to remind them that say, you know, there's a possibility that maybe now you might want to convert that graded premium to a level premium. And I know most of the financial planners that we deal with are not keeping track of this, and it's not something that you need to worry about. We will bring it to your client's attention, and obviously you will be CC'd in on that email also. So here's an example of Sam's friend Dan, who is a first-year in what do you call emergency room physician. He'd be considered a 3M, and he's approximately 32 years old. And as a first-year physician, he's automatically eligible for $6,500 of monthly benefit. He can get a CAT for the exact same amount. And because they know his income is going to go up every year, they're going to give him a future increase option amount of $10,500. And they're also going to give him $1,000 of retirement protection. And on the left is the level premium with and without the retirement protection plan. And on the right is the graded premium. So you can see it's a considerable difference, which is important to them if they're just getting out of school and paying down those student loans. And when we talk about student loans, I want you to just keep in mind, I talked to a client today who has student loans. We do have a program that will cover student loans up to $2,000 a month. So if you have clients that are in that situation, feel free to give me a call and we can talk about that. So let's review where we circle back. We talked about future increase options and how we circle back and talk to your client about the fact that their income may have gone up and we need to make sure that their monthly benefit has gone up. We talked about just now, if you're in the New Professionals Program or if you're not in the New Professionals Program and you have a graded premium, we're going to remind you that you might want to consider converting it to a level. And then again, if an underwriter has indicated that there is a reconsideration period for either a medical condition or a body part, we're going to circle back and see if we can't get that exclusion removed. And another example is this one: we have a smoker. If someone gives up smoking cigarettes in a year, we can circle back and see if we can't get a non-smoker rate on that policy. And our last topic is specialty lines. And specialty lines is used in certain situations when clients have either an unusual occupation or an unusual income. And we use Lloyd's of London. Lloyd's of London is not an insurance company, but rather they determine the risk and they will determine which insurance company will take on that risk. And again, we use them for unusual occupations or someone who has a substantial income. This particular coverage is different than your usual disability plan that we get through our conventional carriers. And by that I mean it has a limited benefit period. It's not going to go to age 65. It's renewable every 3 to 5 years, meaning they have to go through underwriting, and it's like purchasing a whole new policy again. You have the ability to put some special occupation language in there. So if you have a physician that wants to make sure that as a surgeon they're covered, we can arrange that. And the monthly benefits are much higher than the traditional disability that you get, either the 15 or the 16 or perhaps the 20,000 that you'll see in your traditional disability carriers. So let's look at some examples of cases that we've quoted in the past year. I had a professional surfer. He's 19 years old. He's generating approximately $500,000 in tournament winnings, not endorsements, just tournament winnings. And if he should become disabled, he would get $500,000 after a 12-month elimination period. And this plan is only locked in for 1 year, and the annual premium is $20,000. Now, this may seem really high, but if you take a look at this, it's a small price to pay, just 4% of his annual earned income, when you consider that the window of opportunity for him to generate this income is probably less than 10 years. I mean, he's not going to be in this occupation too terribly long. So we'd hate to see him be wiped out by an injury, but if he is, we have a disability plan for him. Another example is a professional baseball player. Max signed right out of high school for $1.4 million. A lot of this is signing bonus. And we were able to provide him with $1 million lump sum if he should become disabled and satisfy the elimination period for 12 months. Again, his plan was locked in for 1 year. His premium was considerably less, but the likelihood of him being injured was less than, obviously, a professional surfer. Unfortunately, he was benched by meningitis, and earlier last year, the $1 million was paid out to him. And it's unfortunate, but he was happy to have that $1 million. Now, at this time, we're at the end of my presentation, and I'll take questions in a few minutes, but in an effort to let you know what's going on with Lolo, I want to review a few things with you. First of all, there's some disability tools available to you on our website. One is the online quote request, where you can request a disability quote. We also have a guide to disability insurance under Advisor Tools. And we have the guide to critical care insurance, which is a part of next month's webinar, which is insurance planning for clients in their 40s, which will be me along with Keith, our omnipotent insurance guru, who will be discussing business insurance protection for your clients and maybe even for you. We also want you to keep in mind that May is Disability Insurance Awareness Month, and it's an ideal time to talk to your clients about disability. We've also posted recent information about the changing long-term care insurance landscape in news you can use on llis.com. And Policy Matters, our quarterly newsletter, which will be sent out later this week to all advisors in our database, Its entire focus is on disability to celebrate Disability Awareness Month. Now, the top 10 things that make Load different. Well, keep in mind that we have free monthly webinars, and next month's webinar, which I'm going to plug again, is Insurance Planning for Clients in their 40s. We're going to cover critical care, business protection, and group insurance. So I certainly hope you tune in, and you can take a look at these and see what the other ones are going to be. Just remember to register and write it down in your calendar so you remember which day it is and tune in. The top 10 things that make Load different. Well, we're not your competition. Our clients are only fee-based advisors. We save advisors time, and we save your clients money. And I know I do that because if we get a rating removed from your client's insurance plan, I know that's saving them money. We pre-underwrite to avoid surprises. We proudly sponsor several organizations that are fee-based advisor organizations. We have product specialists in life, disability, which is me, long-term care, which is Jill, and Jerry Skapiak for annuities. When your clients get life insurance through us, we keep them in the loop through our AIM, our application information message system. We manage your clients' policies both now and in the future with our APE system, our advanced premium email. And at this time, I'm going to open it up for questions. I'm going to take a look at the ones I can answer. How do I answer that one? Okay, I have a question. How about S-Corp K-1 income from a business the client owns? Do this all day long. That's considered earned income, so as long as we can show proof of it, we can go ahead and include that in as earned income. Why would going off medication lower the insurance company's risk? Well, because there are complications with some medications, but the bigger risk is if someone's supposed to be taking the medication and they decide not to, what could happen to them? Might be a claim that the insurance company would be on the hook for. Would stock awards be considered a bonus? Stock awards, if it's restricted stock and it shows up in their W-2 as earned income, we could consider that. Otherwise, we can't consider it. It has to show up on their W-2. Does group disability pay out only if a worker is injured at work? Okay, if a person is injured at work, it's not a group disability. It would be a workers' comp claim. Most disability plans will pay if they're injured off the job. What are the limitations of a group disability versus an individual disability? We kind of went over that when I compared the individual versus the group. Limitations, it would just depend on the plan. I would have to take a look at it. Not all group plans go to age 65. Not all obviously have own OC. Not all have COLA. Not all have residual. So we'd have to take a look and compare which ones would be the better of the two. Do any policies coordinate life, disability, and long-term care? There are no disability plans that I offer that can coordinate both of them. They do offer disability plans where you're getting credit, if you will, for long-term care. So depending upon how long you go and do not go on claim, you'll get a certain dollar amount, and then that dollar amount can be used towards a long-term care plan. Any other questions? Feel free to just raise your hand, and they'll show up on the screen here, and I'll do my best to answer them. We'll unmute you if you raise your hand. Jason? Okay. Okay, I have a question here. How does AFLAC accident insurance impact disability insurance, and what are your thoughts on AFLAC? I have an AFLAC plan, but it's not disability. It's a cancer plan. It has most of their plans have a limitation to it, and it's usually, AFLAC is obviously it's an employee-based benefit. It's coming out of their paycheck. They're usually paying for it themselves, you know, where it's being deducted out of their paycheck after taxes. And if they leave, they can take it with them. So it is a nice feature, but I don't think it's the end-all. I think that they would need to probably look at a standalone individual plan in addition to they might have the AFLAC, but I think they should probably look at an individual plan as well. Anybody else have any more questions? We have a couple more minutes. I'd be more than happy to stay and listen. Well, thank you so much for joining me this afternoon. And again, keep in mind it is Disability Awareness Month, so I'd like to get as many phone calls, as many emails, as many quote requests as possible. And if you're in doubt, feel free to give me a call about a situation, and we can talk through it and see if we can provide some help for you. Again, thanks, and have a great rest of the day. Bye-bye.